As of March 2023, the U.S. yield curve, measured by 2-year versus 10-year, traded in inversion for 424 straight business days, making it the single longest inversion in history. Now, yield curve inversion is a dependable predictor of a coming recession because it's forecasting lower rates further down the road. Now, an inversion has preceded every recession since 1975, and the average time from the initial inversion to the recession is between 12 and 18 months. To be fair, there have been a couple of quick and shallow inversions that were not followed by a recession over the last 50 years, but that instance was rare. Now, analysts' current consensus is that we may be able to avoid a recession altogether in the current condition, as some economic indicators have recently signaled expansion, particularly labor data. Other indicators, though, have not been quite so rosy. In the last 2 weeks alone, we've seen disappointments in Michigan sentiment, ISM, factory orders, retail sales, and Empire manufacturing. The few non-labor upside surprises have unfortunately been in inflation indicators like CPI and PPI. Historically, an inversion tends to right itself as a recession becomes imminent and the Fed quickly lowers rates on the short end and the long end is left to drift back higher in anticipation of blue skies after the recession ends. Now, if a trader believes that the yield curve may steepen from here, they could buy the March 10-year versus 2-year spread contract at -34 and target a move back to zero. A stop for this trade can be placed below at -54. Now, this trade can make $340 if the target is reached and risks $200 if you're stopped out of your level. Now, a reminder that executing this spread leaves you with two separate positions, one in the 2-year and one in the 10-year. So the target and the stop must be manually monitored. Now, if a trader believes that the curve could further invert from here, they could express that by selling the March 10-year versus 2-year spread contract at -0.34 and target a move to the September lows of -0.76. Now, a stop for this trade could be placed above at -0.10. This trade can make $420 if the target is reached and risks $240 if you're stopped out of your level.